If you're listening to this, there's a good chance you work within the real estate investing industry. There's another good chance that you would like to increase the sales of your products or services. Well, you're in the right place. United States Real Estate Investor is a platform you need to place your brand directly in front of your target audience. With our focused, growing audience of real estate investing beginners, enthusiasts, and seasoned professionals, you can continually reach our captivated viewers and listeners with ease. To learn more or to get started today, just visit UnitedStatesRealEstateInvestor.com/advertising. That's UnitedStatesRealEstateInvestor.com/advertising. Get ready to increase your brand awareness and your bottom line. Attract clients with content.
Universe. Media. Network. 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 Network.
Welcome to This Month in Real Estate Investing, where we help you separate the noise from the news. I'm your host, James Brown, and in this episode, we'll be breaking down a variety of real estate investing news items, including Congress is considering a plan that could help homeowners sell their house and actually take their existing mortgage rate with them to the next one. Also, the number of homes for sale in America has climbed to its highest level since November 2019, giving buyers more choices and sellers more competition. And just when buyers thought rates might finally settle down, a massive bond market sell-off has put 7% mortgages back on the table. Don't forget, if you're watching live on YouTube, you could share your thoughts and questions during the show. We can jump in and answer those. Also note that if you're an investor-focused agent, you can apply to join our network. Or if you're an investor looking to connect with an investor-focused agent in your market, go to UnitedStatesRealEstateInvestor.com/agents. All right, let's start the show. All right, our guests today are Mel Dorman, Patrick Yepes, and Nathan Turner, back for probably the fifth time. Why don't you guys introduce yourselves, kind of share what you guys are all about, your background in investing, and we'll start with Mel.
Yeah, so I run the Seller Finance Academy, and basically in the last year, I built a following of over 1.5 million people, teaching them a practical way to build wealth through neighbor-to-neighbor relationships, which is seller financing. So I've basically packaged something that a lot of real estate investors are very familiar with and brought it to a larger audience in the form of a social justice movement that's really taken fire. So yeah, about 270 students in my program now, and I've reached, well over millions of people.
Wow. Amazing. Awesome. I'm so glad to have you on. All right, Patrick.
Mel, I'm impressed. By the way, I'll do the short version. We'll be here all day. I started out as a real estate agent. Did my first fix and flip about 35 years ago. I have been an active real estate investor most of my life. I do have a second company, which is Dream Big Digital Products. We create digital products and software applications for real estate investors. And I have a company which is called Dream Big Marketing Services. I have a lot of coaches and a lot of big fish in the industry that are clients of mine. As of late, we've been offering what's known as geo optimization or generative engine optimization, and it's been phenomenal. It really is impressive in how it helps companies scale and get to the next level, and get to be found by the AI engines, to be found, recommended by the AI engines. So we're really big on that as of late.
Fantastic. Nathan.
Yeah, Nathan Turner. I have been a note investor for the last more than 15 years now. So I started out actually with seller financing, where I was creating seller finance notes. Moved from that into buying non-performing loans back in 2010, 11, 12, all the way through 2020. There were a lot of those going around at the time. So I worked those out, figured out what to do with them, get people making payments if that was a possibility. Moved from that recently into buying just performing notes, mostly seller finance notes. And then I also run an annual conference all about note investing and just the world that exists within notes. And we have a really good time doing that as well.
Fantastic. This is going to be a good spread of different knowledge. So I love it. All right, let's jump into the news. From GovInfo, Congress considers portable mortgages that could let homeowners take their rate with them. This is interesting. Anybody want to jump in on this one?
Yeah, I mean, this one caught my eye. I actually did some social media content on it this week because one of the things that I teach in my program is how to make your debt mobile, to like negotiate directly with a seller, to make really good terms, 3, 4, 5% interest rates, interest only, things like cash flow really great. And then negotiate during that initial interaction the ability to move the debt from one property to another. So I think it's really interesting that the government is now offering, like, considering that as an alternative. But I actually don't think it's probably going to go through because the banks would lose so much money. So I'm hopeful. Like, I would love for this to happen because I think it would create a lot more movement in the marketplace. More inventory would come up. We wouldn't be in such a locked position between buyers and sellers right now. But it would mean the banks would lose a lot of money, and we don't typically vote that way in this nation.
I agree. I don't think the banks are going to go for it, so I think they're going to stop it dead in its tracks. Interestingly enough, so I live in Canada. This is actually fairly common in Canada. We did this on our own home when we moved across the country. And for us, it works really great. And I think the reason it works in Canada is because all mortgages have a short term. So it's amortized over 30 years, like a regular US mortgage, but then there's a term built in. Usually around about 5 years. There's different choices, but most people choose 5 years. So because there's that refinance in your future, it makes sense for the banks to go along with this and say, well, that's fine. We'll get them on the next rate change in the next couple of years as soon as that rate, or as soon as their term is up.
Wait, is it a balloon in 5 years or a forced refi?
Essentially a balloon. And so then you're having, it's an interesting environment. So then you're going around shopping to all the different lenders every few years and see who's going to beat the rate by, 0.25%.
Interesting.
Wow.
Yeah, that's. I was wondering about that. Go for it, Patrick.
I agree with both of you. If ideally or hypothetically, if that could occur, it would really help, in creating more inventory, at least in the middle to upper market, as people can, there's many people that are sitting on their properties, and they're there because of the great mortgage rate that they got years ago. So it'll definitely help the middle and upper market. Obviously, it's not going to help the lower market, the first time buyer, very much. But hypothetically, I mean, if that could happen, there would be some great effect in that respect. But I agree with both of the other panelists that it's dead in the water. I don't think it's going to have a chance with considering how powerful the banking mortgage industry is. It's not going to happen.
Yeah,
and I agree. I think it, like you say, it helps those who are already in the market if they're looking to move around. But for those first-time buyers, this doesn't help them at all.
No, it'll open up inventory, get things moving. Which, as an agent, I would love that because we're in the worst inventory situation rates since '95, right? So it's brutal. One thing I was questioning is whether this was going to be primary home buyers and sellers only, or if it would include investors.
I can't imagine it including investors.
Yeah, it'd be nice, but
yeah, it's definitely not in anything, any documentation. Of course, I jumped on Claude. I'm like, hey, have you found anything written into this proposal that would include us as investors? It's like, nope. So TBD if it even passes, like you guys said. Yeah, it's interesting. I love that they're thinking creatively. Like, what do we do here, right?
Yeah.
But the reality, we'll see. All right, let's jump to our next article from Redfin. Typical U.S. home still requires nearly $110,000 in annual income to afford. So it's saying the estimated median household income is $87,599. So that's a gap of $22,000, making it tough for people to buy homes.
I am amazed, and I think we probably all are. And when I think of this, I think of my parents or grandparents talking about inflation. I remember when, and I find myself also falling into that trap of I remember when pizza was 50 cents, and what have you. It's insane that you would need to earn that much money to buy, a home. And I unfortunately, the inflation and the fact that the prices of homes, which I think many of us thought might adjust years ago, haven't. And, in selected markets, there's been, slight adjustments, but generally speaking, the prices have stayed pretty strong. I think that's where creative financing really comes into play. To be able to, even as an agent, I was a real estate broker for about a decade. So even as a real estate agent, understanding creative financing, understanding that, there's more than just the price of the home, and that you can affect the affordability factor by using some, and not really some, phenomenal or complicated creative financing strategies, just, some simple things like helping or asking the seller to buy down the buyer's home rate, maybe asking the seller to put some money to help cover some of the closing costs, or, possibly a second mortgage, in order to help the buyer enter the home, or from an investor's perspective, using some of that creative financing so that the numbers, not so that the numbers make sense, so that you have a safety margin when you enter into purchasing an investment property. I think this underscores, or this reality underscores, the necessity for real estate investors and agents as well to really understand creative financing and use that as, within that there's many strategies, but use that as part of your, your tools in your toolbox moving forward, whether, as I said, as an investor or as a real estate agent.
Yeah, absolutely. Yeah, and I think I totally agree, and I want to hear Mel's comment on the creative finance, because absolutely, this is where that comes into play. I think this also speaks to just overall affordability, and I think we're seeing already, and I think we're going to talk about it in a little bit, but we're seeing already price adjustments happening. We're seeing houses sitting on the market for longer. And I think we're headed down a road here where we're going to see a lot of some difficult things coming up, and some people really having some difficulty in making payments on whatever they're making payments on. And I think it really stems from this, and it's just overall affordability and just not enough income for the price of everything else. And that's going to be a really tough thing to come out of. And I'm not exactly sure what the end of that looks like, because it's such a global thing. Like it covers everything. So how do you recover from global shortage? That's a tough thing.
Yeah, it's like we're running into the issue of, during COVID, we printed, at least in the United States, we printed $1 in every $5. So, prices skyrocketed, and that was our solution at the time. And now it's backfiring because prices went up, but labor and wages did not keep up. And so now people have this deficit, this affordability issue. And I think it's not even just the affordability. Yes, prices have gone up. Yes, interest rates have gone up, but also the mortgage availability index, at least in the United States, has shrunk from like 190 pre-COVID to like 107 now. So there's less products for consumers to even use. And so I think what's going to happen, and what I'm trying to start and, and create market disruption, is I do think the American public is going to have to lean into creative financing. You know, we did this in the 70s and 80s when interest rates jumped up to 17, 18%. People started trusting each other again and started cutting out the bank, the middleman, and started pocketing that at 12 or 13% instead of, 15, 17, 18%. And so I think it's both a really sad thing to watch, but also I think this is what moves a population towards a different solution than institutional financing.
Yeah.
That's where the opportunity lies for us.
Mm-hmm.
Right.
Yeah, exactly.
Yeah, I mean, just to throw something else out there, like it's so simple too. Like not only the documents, you guys know, it's like 5 or 6 pages for promissory note, deed of trust. It's not this huge 30-page document that banks hand us. But on top of that, it's so simple to make the numbers work. Many times it's just changing it from amortized to interest only. The payment drops by 1/3. Suddenly something cash flows. As long as you're in a market that's appreciating, which most markets are because of inflation, then as long as you have a long enough term, you're not really so worried about paying down the principal during that time. You're mostly worried about cash flow or affordability, which is what we're talking about in this Redfin article.
Yeah. I'm in the rent to own space, mainly on the creative financing side. So as prices have kind of flattened, like especially Denver, I'm in Denver. We do rent to own anywhere in the country, but here it's just kind of flatlined. It's going up a little bit in single family. So, but we're always having to put in our option contract a price in the future, right? It's like, oh, well, where is it going?
Yeah.
It's a guess. And so it's kind of harder because a buyer in a rent to own situation is going to be like, well, I'm paying this higher price, like, is it going to be worth that, right? And will it appraise? So it's having to kind of rethink things and adjust.
Mm-hmm.
Yeah. Anyway.
Yeah, for sure.
Well, let's go to the next one from Mortgage News Daily. Mortgage rates fall to their lowest level since July 20 after weak jobs report. It's talking about the bond market and how it relates to mortgage rates, which it's not a direct correlation, but you guys have any comments on that?
I think
where
this
things are going?
It's sort of part of the new normal. And I think collectively we got used to these ultra low rates. And so if we see something over 2%, we're like, what? That's crazy. I think reality, 7 is a little high. I think a good rate, normal rate environment is going to be somewhere between 4 and 5%. So we're not too far off of that. Now, that being said, 2% on your mortgage over that 30 years, that translates into a lot of money. Yeah. And so that is definitely a major consideration. But we're not at, the 1980s where it was 17, 18%. We're at 6 or 7%. So it's high, but it's not ridiculous. And part of that is just getting used to that coming off of those ultra low rates. But again, affordability also plays into that. And if these rates, even though at a 6 or 7%, that's not astronomical, but if your income doesn't support that, then it's still too high.
Yeah.
I'm wondering too, like, I don't know if you guys have sensed this, but I see a lot more underemployment or unemployment than what I feel is being reported, because I'm constantly seeing, especially white collar folks, talking about they just got laid off and they've got laid off again, and companies are downsizing, and Amazon's, laying off 20,000 people, and, all these really big companies are doing these huge layoffs. And I don't really see it reflected in the reports because I don't know if it's just my portfolio sample, but I see a lot more unemployment or underemployment than I think is being reported. And I don't know if it's the way that the numbers are reported, but for instance, a lot of my generation and Gen Z, they're holding multiple jobs in order to make ends meet. And so they're not going to show up on that jobs report because they have 5 part-time jobs, or, they're driving for Uber on the weekends and they have this side hustle. And so they're going to look like they're employed, but they're not actually fully employed, and they don't have benefits, and they're scraping by. And so I think this is really my sense is very under. I don't want to cause a panic.
It typically is.
Mm-hmm.
Whatever the news is, it's typically behind in whatever it is. So I agree. I think it's probably unemployment's higher than that. We're in an interesting time too, where we've got this introduction. We're right on the very forefront of AI and learning what it can and can't do. I think some companies are jumping into it with both feet, and that can be good. Maybe, but it's too early to tell. And how much can it really do, and how much can it actually really replace people, and do we want it to? That's the other side of the question.
That came up quite a bit in the Build conference I just went to in the last day and a half. We were talking about not replacing people, but enhancing people, right?
Yep.
Like give them the AI tools, but they're running them, right?
Mm-hmm.
Yeah. But there are some jobs that they're just going away. So I guess
but even then, and same, I was part of a mortgage AI conference last year, and we were talking about the same thing. It's really an enhancement. And they likened it to way back when you had the gas lighters, the guys that would light the lamps at night. And when electricity came in, well, that's a job that just disappeared.
Yeah.
But at the other side of that, electricity then provided and created all kinds of jobs that had never even been considered. Mm-hmm. And so I thought that was a really good analogy, because I think it's really the same kind of thing. We're out there lighting lamps, and then there's this new thing that's going to change a lot of stuff, but really create all kinds of things that we haven't even considered yet.
Mm-hmm. Yeah. I just see the economy more and more. Tough. Yeah. And I just see it more and more moving away from like working for big corporations and institutions to people really starting their own small businesses and serving people, small group of people, small group of companies, because the unpredictability of large corporate jobs at this point, people are realizing it's not as secure as they thought that it was going to be, and how quickly they can be replaced. I'm thinking of Intuit, because I have a friend there that's an economist, and he joined like a year ago, and the stock has dropped 80% since then. Wow. And, they're getting emails about you have to increase your productivity by 3x in the next 6 months using AI, or you'll be fired, like company wide. And It's just like you're seeing these really big companies trying to, keep their constituents happy, to help the shareholder. They're not thinking about the stakeholder. And I think fundamentally that's where our economy has gone wrong over the last 30, 40, 50 years, is we've gradually moved away from these mom and pop shops, people who care about the stakeholders of their company, the employees, the worker, the company that wherever it exists, the neighborhoods, and like they actually care when they make decisions for each one of those stakeholders. Mm-hmm. But when you have a shareholder-based economy that is mostly large corporations, they're really just chasing profit lines at the expense of the American worker, at the expense of the communities they have their factories in, and all that. And I think what we're seeing is the sort of late stages of capitalism, where that's coming to a head, where that business model has run out of steam, and people are becoming increasingly resistant. Gen Z is increasingly resistant to getting a job, because what's the point? Like, I'm going to work really hard for what? So I think we have to have a big shift into a smaller business economy.
Mel, to continue on your point, as a small business owner, you need to adapt. And, when the internet came around, when I was a real estate broker, it was the yellow pages, business cards, and we sent out mailers. That was it. Snail mail. That was basically it. So you need to adapt to the technology. And sure, the internet has its problems. Social media has its problems, but we're a hell of a lot better off, having the internet rather than just the yellow pages. And I think the same thing is true with AI. And the decisions that large corporations make, even small business owners have to make the same decisions. Because at the end of the day, whether your stakeholders are shareholders, or the stakeholder is your wife, your family, your pocket, you still need to make those decisions.
Sure.
So if those decisions are being made by large corporations or by small entrepreneurs, because the decision is being made by a large corporation doesn't inherently make it wrong or make it cruel, or however you want to box that in. As a small business owner, I've come to realize, and we hired a phenomenal gal out in Australia who helped us and dissected our entire business, or all our SOPs, to integrate AI in everything we do. You have to stay ahead of the times. You have to stay with the times, rather. You have to work with the technology that comes in. And at the end of the day, the corporations are there to make a profit, and that's it, period. And me as a small business owner, I'm there to make a profit. That's it. If in my journey to make that profit, that my process to make that profit, I can, be socially conscious and all those things. That's nice. It's important, but you've got to make a profit. There's just no ifs, ands, or buts about it. If I don't adapt, and if the companies don't adapt, and if we don't fire people, if you have to be fired, and if you don't downsize, or you don't insist that the team, in my case, that my team be more efficient, then you're going to stay behind. So I think that's something inherently necessary if you want to stay profitable, and if you want to, if you want to be around and get invited to a podcast, to a show like this. So I don't know that it's necessarily inherently wrong. It's just that's what the corporations are there to make a profit. That's their number one obligation. As a small business owner, the number one obligation is to survive, to make a profit and to wake up to continue another day.
Yeah, I should be clear too. It's not that profit's bad. It's more that, it reminds me of like the like Stanford prison experiment, right? Like they put a bunch of kids in a basement for a few weeks and they said, you're going to be the guards and you're going to be the prisoners. And it took like hours before they totally dissolved as human beings into these like atrocious roles that they were taking on. And I see corporations as a really similar thing. Like these are not evil people. These are not people trying to do harm. This is a conglomerate of people that the system is set up in such a way that the thing that they're all focused on is the profit margin, versus the small business person. They are interacting with their employees, they're interacting with their community, they're interacting, with the other stakeholders. And so there's a little bit more accountability built into their actions.
Empathy, maybe. Empathy as well.
Yeah. And they tend to have a better idea of what success is, right? It's not just this number that we keep trying to push up at all costs. Who cares what we have to do to get there? It's all about our shareholders and what they want. That economic system, I think, is what has gotten America into the place where it's at, where workers' rights are being drained, where affordability is a crisis, where most Americans cannot buy their own home, can barely, they're living paycheck to paycheck. I think all of this actually is very much tied to the stakeholder versus shareholder mentality. And so until we can curve the expectations of what a corporation's trying to achieve, I think we have to just have less corporations being the ones in charge of our economy.
I'm just going to circle back, if you don't mind, to the question at hand, the article at hand. When I was reading it, and I thought to myself, it's a mixed bag, because who doesn't want lower interest rates? But you want lower interest rates while the economy is improving. You don't want lower interest rate while people are, as you said very well, Bill, underemployed or not employed. So you have these two forces at work, where as an investor, you see the rates are going down. You're saying, oh, okay, so this might open up some opportunities, maybe for those somewhat marginal deals that we were looking for that might make a little bit more sense. Although the fundamentals, and having been a real estate investor since the 80s, late 80s, at the end of the day, you've got to analyze, you have to underwrite, you have to see where you're at today. You have to analyze what's here at the moment. And of course, you're going to factor in, appreciation. You may, factor in other things that might help increase the property, the value. But I think where we get lost is anticipate things or try to predict things. It's I think in the prediction where a lot of real estate investors get caught with their pants down. As an attorney friend of mine who used to represent me used to say, don't get caught with your pants down. It's when you anticipate, oh no, the interest rates are going down or whatever the case may be. And I'm going to invest in this property in spite of the fact that the numbers aren't right there. Now, I remember when I was in the heyday of the market, when you could do everything wrong and you can make massive profit. It was insane. I mean, and I remember everybody and their mother was an investor. And even myself, where I had marginal properties, where I thought, I underbid it. I don't know if I'll do it, but I would just say, the heck with it. I'll go with it. And you could go, you couldn't, there were, first time home buyers who purchased their first home, and they would jump in it and they say, I want to become a real estate investor. And people were making profit left and right. That was, for 5 or 6 years. But at the end of the day, the fundamentals go back to the fundamentals. And you've got to analyze the property as it is today, analyze the cap rate. And I know we're going to talk about that in multifamily as it is today. Yeah, you're going to factor in some things, some expectations. But if you factor and you see what the situation is today, it's less likely you're going to screw up and lose money on your investments.
Yep. Agreed. Trying to make that crystal ball prediction is dangerous territory.
Yeah, absolutely. Yeah.
Yep. This is great, guys. Let's take a break, learn from one of our partners.
If you are serious about real estate and tired of guessing, you need to know about Real Expert Talks. This is where real questions meet real experts. As a member, you get direct one-on-one access to experienced real estate professionals. No courses, no fluff. Just focused video calls where you ask your question, get the answer, and move forward fast. 5 minutes, 15, or a full deep dive. You choose. One conversation can save you months of mistakes. And if you're an expert, this platform was built for you. Real Expert Talks lets you monetize what you already know. Set your own rates, control your schedule, get paid to give advice, build your authority, and expand your reach without chasing clients or selling anything extra. No middlemen, no noise, just expertise, access, and action. If you want answers, sign up as a member. If you have answers, sign up as an expert. Go to Real Expert Talks and turn knowledge into momentum. RealExpertTalks.com.
All right, let's get back to the show. From CRE Daily, apartment cap rates reached their highest level in 11 years. It says they reached 5.79% during the second quarter 2026, up from 5.71 in the first quarter and 5.52 1 year earlier. Patrick, you had some comments on that, right?
All right. So the fact that the investors are looking for a higher cap rate, I think it shows a couple of things. The investors, I think, are being a little more conservative in what they're willing to on what investments they're willing to pull the trigger on. And I think this particular article kind of highlights that, the fact that they're looking for that extra cap rate. Even with extra cap rate, though, you have to, and I think it goes back to that fundamentals of analyzing the entire investment, and not only focus on the cap rates, but take into account other factors, other expenses, other costs, which are related to every investment, any real estate investment that you do. And again, I think it's to factor in those other, not to predict things, but to factor in other indicators, the job market, the interest rates, depending on what market you're in. It could be that, there's a major construction project from a major $billion investment that's coming into your community, and factor those things in. Or maybe in your community there's been a major company like Amazon that's cut 20,000 jobs, or maybe moving out of the community where you're analyzing properties. So I think it's an indication that investors are looking to make sure through requiring or expecting a higher cap rate, they're looking to play it a little safer, looking to make sure that the deals that they're looking into are not going to make, it's going to be a wise decision.
Yeah, man, there's been some fallout recently. Some big names in the space have lost some money. So when the ones that everybody thinks, oh, they know what they're doing, are having issues, then the ones that aren't as experienced are like, ooh, what am I doing here? What am I missing? Right. And so they're being more conservative, rightfully so. Yeah.
And it is surprising to see some of these, gurus, that have recently been caught with some major losses. And I think not knowing the details, really well, but I think it's that we fall into this trap of, trying to predict the future, and unless you're Warren Buffett, maybe, and a few of us are Warren Buffetts, it's a sure way to screw up. If you want, you could factor that into the decision, but you can't make a so-so deal, convince yourself, and we as investors do that. I've done that. Well, you know what, and we do it. I've done it. I've lost money I've lost money along the way. And usually when I've lost money is when I've done that. The things look good. Let me pull the trigger on this. Sometimes when I had a very big crew and we were building homes and doing major rehab work, I would say, well, it's not such a great deal, but I'll pull the trigger, and on the way, my crew needs to stay busy.
Right.
I need to flip the money that I have from private investors or what have you. And as an investor, could easily justify purchasing a property. And when I've done that, I've made maybe, marginal profit. Luckily, I haven't lost money on too many deals, but, or I've lost some money on the deal. And so, again, I've learned, don't, if the deal is not a good deal, don't convince yourself in spite of pressures. We have pressure. We have pressure to produce, to get another deal on the board. I had at one point, my private investors would call me, hey, Patrick, I've got, $500,000 sitting in an account. Do you need the money? I'm going to lend it to somebody else. Or my crew, would say, hey, we're running out of work. And you kind of convince yourself when you have a marginal deal. And I've been guilty of that, of pulling the trigger on that. And I'd say as an investor, if you're a newer investor, particularly, make your decisions based on what's on, here today. And I'm kind of repeating what I said before, but it's so important.
So I'll throw in a little bit of a commercial for seller finance and notes in general. Is one of the things that kind of drove me this way was multifamily, not myself, but it was actually my father-in-law, and got into a couple of different deals that promised all kinds of really great things, and they fell apart. 2 separate deals totally fell apart, and he ended up getting about a quarter of his capital back. When I contrast that with notes just as an asset class with a note that you've created or you've purchased, it's an established set of terms. So whatever it is today is what it is for the next however long that term is, 20, 30 years, whatever it is. With fairly good accuracy, you can predict whether that person is going to make a payment next month and the month after that and the month after that. So it's not a predictive return sometime in the future when this building gets built, or once this, rentals turn around, once something happens, then we'll get some kind of a profit. No, it's immediate profit. I bought it today based on the terms that were already established, and that's how we go moving forward. So it's a much higher predictability in making sure you're getting paid and knowing exactly what you're going to get paid.
And a heck of a lot less riskier, for sure.
Yes.
True.
Yeah.
That's true.
Less moving parts.
Absolutely.
Yeah.
A lot of these multifamily deals, they're value add. They're flipping apartments is what it is. And so I've seen,
and they can be great.
They can be great. Yeah. I've been involved in a few. All of them have worked out, but potentially that's because I partnered with people that know what they're doing and stand by what they need to do when things go wonky. But they're all facing the same thing, right?
Sure.
Materials costs going up, insurance, and especially in some areas going up. They're holding costs, like the refinance risk of multifamily, right? Like those are usually 5 to 7 year terms.
Yeah.
Oh no, the interest rates went up and they're getting pinched. Where, like Nathan, what you're talking about, you amortize over 30 years and plug
no
along.
Construction costs, no, whatever's happening out in the market is really, we're fairly independent. Not, I wouldn't say 100%, but mostly independent of whatever's happening in the market. So whatever the terms are today, that's what the terms are for however long that term is, the next 20, 30 years.
And Nathan, I think the ultimate goal of investors, right? And I'm thinking of myself, you need to be in the trenches. You need to take the risks. You need to make the money.
Oh, yeah. Mm-hmm.
The ultimate goal, as Dan Satofsky, who you know Dan pretty well, says, become the bank. So the ultimate goal is one of two things: become the bank, or become a lender, or buy notes. So now you've raised the capital. So the logical next step, I've raised the capital. We get older. I don't know. I no longer do 3 or 4 or 5 massive flips at once. In fact, now I don't even do massive flips. Now I just do cosmetic flips. But we're getting older. If we've done things right, we've amassed some capital. And so then you say to yourself, okay, maybe at this point, let me be more conservative. Put my money to work, but be more conservative. Let me become the bank. Let me take back the notes, or let me purchase some of those notes that Nathan that you buy and sell, or lend money to other investors, because but there's not, as you said, James, there's not all these, and there's dozens of moving parts when you're a real estate investor. I mean, dozens, some which you're keenly aware of and some which just surprise the hell out of you. I'll just briefly, I purchased a property. It was going to be a home run as far as I thought, and did my due diligence, and I didn't TV the sewer line. Had never TV'd a sewer line. Didn't think it was necessary. The sewer line was broke. To make matters worse, it was a county road, a very large county road, which had been repaved less than a year ago. So I couldn't do anything. I had to hire a company that was approved by the county, and I don't think it cost maybe more than $2,000 or $3,000, but it wound up costing me $20,000 because we needed to open up the sewer line and then repave the entire street, not the lengthwise, but from my curb to the repave it. And those are those things that you never and now I learned to be very cautious. But there's so many moving parts, as in the case of this particular property, that it makes it risky. So that logical next step, if you're able to amass enough money, is to move into the notes and what have you.
Yeah. Let's jump in. Oh, one more comment.
No, just I'm a fan. That's all.
Cool. From Realtor.com, U.S. housing inventory reaches its highest level since November 2019. We're climbed to 1.2 million. That was another topic at the build conference I was at. It's still low.
I was going to say.
This goes back
that was not a good
Patrick.
time.
Yeah, right. This goes back to what you're saying, Patrick. Like, things happen and you're holding on to property, and then all of a sudden the value starts dropping, and then what do? And for sure, I think probably we've all been affected by this in some way or another when I own property, and I do that as well. But we're seeing exactly this, where it's sitting in the market a lot longer than it used to, and we're having to do price reductions, and we're having to do this and that, and suddenly, this all happened very quickly. 6 months, all of a sudden, it changed from we were getting multiple bids to now all of a sudden we're price cutting, and wow, that was quick. And so that's just kind of a reality that we're trying to get used to, and then figure out how to deal with that. And in some cases, it's offering seller financing, and we'll take back a note rather than having to go to the bank.
Yeah, I think
Go for it.
Well, I was gonna say, like, I think one of the things that we're up against is most people have this sort of win-lose mindset when we're talking about investing, because there's really just the one thing that we're negotiating over, the price, right? It's like, I win if I get the price down, and they lose if I do that. But I think the difference with seller financing is you open up a world of opportunities to negotiate. So I can very easily give up the price to a seller and make them very happy, which is what they want to see. That's what they want to tell their friends at the barbecue, that they got a great price. But at the other side of things, because we're not using a bank, we can negotiate the interest rate and the down payment and the length of the term of the loan. And all of these things start to become levers that we can negotiate back and forth until we do find something that's truly win-win. And I think that's the skill set that most consumers just, one, have never even heard of, and two, they don't even know is available, like a possibility for their life. And I think what's happening is we're seeing an uptick in creative financing, we're seeing an uptick in seller financing because of this deadlock. And even, going back to 2019 November, like, I was a realtor at that time, and it was a very hard time. Much like today, it's just very low inventory. And so I think in order to get us out of this buyer versus seller mentality, which is older buyers, this is their nest egg, they're really afraid to let it go, because any appreciation they lose is appreciation that they're not going to have for their retirement, versus the home buyer who's can't get into a house because there's not enough affordability. And so right now they're in this sort of deadlock situation, when in reality they could be each other's solution. If they understood that the seller could save in taxes, could maximize the gains they have on that one investment, and meanwhile the buyer can get an affordable rate, can get a lower down payment, can cash flow, or at least have a payment that's affordable. Those things can be solved without just by cutting out the bank, as you guys know.
I'm mainly a listing agent here in Denver, where we have big run-ups and comes down, or at least flattens like it is right now. And so we got a lot of days on market. If you don't price right from the beginning, it's been tough on us as listing agents. But one thing I do, because I come from the creative financing side, when I do a listing, I tell my sellers, hey, we can open up to even more buyers if we list this as a seller finance lease option, whether they want to do it or not. Because my main business is lease options. What we can do is, if a buyer comes in and they can't get a loan and they fit our program, me or one of my investors can come in and buy that listing for that, and buy the person that can't get financing right now. So it opens up, more potential buyers, solves that problem. So,
James, you're reminding me of a listing appointment I took about maybe a year and a half ago, and this woman had just inherited a duplex from her mom who passed away. And I got to the property as her agent, and he said, $550, and she agreed. She understood the market pretty well. And I just looked at her. Her name was Cynthia, and I said, Cynthia, how would you like to make a lot more money than $550,000 on this duplex? And her eyes got big. And I was like, well, you see, if you offered an interest only versus an amortized payment, you could boost the price by 10%. So instead of $550, you could put it on the market for $610, and you'd beat every bank offer, basically, because the buyer's payment goes down several $100s. And so she's thinking about it, and she's like, actually, I know who the right person for this is, my tenant. His name was Abdul. He was a doctor. He made $350,000 a year. He was just like as good of a buyer as you could possibly imagine, except he he was Muslim, so he couldn't pay interest. It was against his faith.
Oh,
So
interesting.
he was completely locked out of bank financing.
Interesting.
So I said, can I call up Abdul and have a conversation? She said, yes. So I call him up and I say, Abdul, would you like to pay a 0% interest loan on and buy this property? And he's like, yeah, I would love to. And so I just asked him, how many years would you like to pay this over? And he told me, and I took what would have been the interest and I put it as principal. And instead of selling at $550, which she would have gotten on the market, Cynthia sold it for $725. She got $175,000 more than what she would have gotten if she would have bought with a normal bank buyer. And so it's just, as a listing agent, as an agent, it opens up a world of opportunities, because every other agent that was talking to her was naming 550, 560, 540, whatever. And I came in with 725 in a solution that didn't even require marketing. So it's like, if you have these tools in your tool belt, it expands your ability as an agent exponentially to serve your clients.
Definitely.
And I'm sure for you, Mel, for Cynthia, you are the best thing since sliced bread.
Yeah, she's stoked. Yeah, she's stoked.
Yeah. I'm going back 35 years ago. Creative financing wasn't as common, though it's been around forever. And what I used to do pales in comparison, because I think what you guys, both you, James and Mel, what you did was brilliant. But I was a listing agent. That was my, as you, James, I always tell realtors, you want to make money, focus on being a listing agent. But having said that, I would say, in the comments in the MLS, when you used to, put it, in the MLS reports, I would say, let's offer out of the gate, $5,000 or $10,000 towards closing costs, as part of the package, part of the offer. Other things as well. I would recommend to do a home inspection even before we list it. So let's disclose the things right up front. You gain the trust of the buyer, and be willing to, maybe contribute something towards, in addition to giving a credit, maybe something towards some points or something. With that same mentality that you're going to open the pool of potential buyers. In my case, slightly. In your case, Mel or James, of your strategy, you're opening it up even more. But I guess for those that might be realtors or hybrid investors that are listening to us, I'm sure they can agree with that. Agree that with the fact that creative financing, from a listing agent's perspective, gives you a lot more likelihood to be able to sell a property. And in your case, Mel, which is a perfect anecdote, and sell it in some cases for more than you anticipate.
And if you're going on a percentage-based commission, you made more too. Right. She's happy and you're happy too.
Right.
Exactly.
Yeah. Win-win. I love it. Cool. Well, let's jump to our next article from Commercial Observer. 61% of investors hold a negative multifamily outlook, but 82% still plan to expand. We're just optimists, aren't we, as investors?
When I saw that, I thought to myself, it makes perfect sense. Because there's a mixed message there, just from the title of the article. But it's true. And I think it has to do with the fact that, you have a war going on. The economy still hasn't really, recuperated. Inflation is a persistent problem. And so for the short term, and that the title to that article makes sense. For the short term, investors are, not that enthusiastic. But I think the title really points to the fact that, in spite of the fact that maybe for the short term they're not enthusiastic, for the mid and longer term, they are. And I think it makes perfect sense. I think you're not enthusiastic today because of the conditions, but hopefully the war will end. Hopefully the economy will get better. And I think as investors, they're maybe hedging that things will get better, and that's why that outlook in the future could be considerably more positive.
Jobs and affordability are a big factor with multifamily, right? If people can't afford a home, they're going to rent.
Mhm.
So that's one, good thing for multifamily when you're predicting where it's going, especially if the economy is going to get worse, which it might, or stay flat. And it's not turning around anytime soon from every economist I follow, right? So that's probably one thing that's in the multifamily investors' minds. Like, oh, and we're, when you've been in this business long enough, there's cycles. So
Right.
we catch this next wave and prepare for it, right? So.
And again, devil's advocate, I see this and I go, well, it's a predictive thing. And I'm not even that old, but I'm getting too old for that kind of thing. Predicting that maybe it'll get better at some point. And I'm personally, I'm not interested in playing those games the same way that I used to. And I love that game. Don't get me wrong. And I did a bunch of that, but I'm to the point now where I'm looking at, my 2 girls are moving out next week. Got my son left for 2 more years, and then that's it. And it's my wife and I. And so I'm potentially 2-3 years away from being empty nested, and then what? So I'm looking much more at stability, and I'm looking for predictability, and I'm looking for, not being an optimist is great, and I am, but I'd much rather put my faith in something that I can see long term. So that's myself. I'm part of the 18% still like, nah.
Gotcha.
I think there's been some studies. I was reading one recently where they're talking about just how bad we are at predicting.
Yeah.
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 I'm definitely not a gambler. So.
Like I say, that's just devil's advocate. That's where I come from. And I don't know if that's going to be something that's going to become more popular for people. I tend to think it is. I think as people get tired of getting beat up, they're going to start looking for things that are a lot more predictable and settling for good returns, but letting go of potentially fantastic returns and getting comfortable with but I know this is going to do its thing. And that's a far more comfortable place to be.
I think that comes with age, though.
I think you're right, for sure.
When you're younger, you're willing to take those massive risks.
Sure.
For that massive return, because if something goes wrong, you've got time.
Yeah.
On your side to make up for it. But I think as you get older, you start saying, well, if I take these large, risks and things don't work out, that horizon is not there, as it is when you're, an investor, you're 25 or 30 years old.
And I've definitely had some of those home runs, and they're great, and they're a lot of fun. And man, they're a lot of fun to talk about when you're in a group of friends. But then, I think it's an age thing. As I get older, I'm like, maybe not. Maybe I can just set up for long-term income. That sounds pretty good.
Yeah. Are you guys seeing in your groups and like local meetups, less people showing up? That's what I'm seeing here in Denver. Like, just not as many numbers of people showing up to any of the
we've seen
physical
for our annual conference that we do 2026 and 2025 were both lower attended and from what I understand that's actually industry wide, like all conferences, all gatherings like that these last 2 years have been much lower, and there's all kinds of theories on why that can be. I think unpredictability is a big part of that. And speaking as a Canadian who can't vote in the United States, I'm totally agnostic to whatever party is in power. The fact is it's unpredictable right now. And you get a new announcement every other day and you don't know what's going to happen. So I think that's a big part of it is people are just not exactly sure what is going to be happening and what may or may not be something they can count on. So there's less excitement for going out and traveling and learning about new things because that can change tomorrow.
Yeah.
I think this is somewhat related to your question, James. What I have found, I do a lot of workshops and master classes with coaches, and this is not today. I'm going to go back about 2.5, 3 years ago. There was a time when those high-priced coaching programs were selling, very, very easily, particularly during COVID and for about a year after COVID. And what many coaches that I work with have done is they've adjusted their prices to make it more affordable, because it's really very difficult to sell a $5,000 or $10,000 coaching program. You can get some of those people there, but and I think it has to do, kind of with what your question, James, and you mentioned, Nathan, that things are so unpredictable that investors are more hesitant to invest in a $5,000 or $10,000 coaching program. I found that around the $1,500 is a sweet spot, $2,000, and with a number of coaches that I work with in the space, and I think it has to do with what you said, Nathan. It's right now we're in an unpredictable, state with so many things going on that I think they're a little bit more reluctant. They're more reluctant to spend money if they don't have to.
Yeah.
Yeah. All right. Good discussion, guys. I love this. Let's take a break and hear from our next partner.
Are you looking to elevate your business through exceptional content? Universe Media Publishing is your gateway to success. We understand that in the world of business, content is king, but not just any content. Your business deserves content that captivates, convinces, and converts your audience into clients. At Universe Media Publishing, we specialize in crafting SEO-rich web content, persuasive copywriting, and marketing copy that resonates with your audience. We don't just write, we engage, we connect, and we deliver results. Imagine your brand's voice amplified, your message crystal clear, and your presence dominating the digital landscape. That's the power of partnering with Universe Media Publishing. Don't let your business just blend in. Stand out, be heard, and make an impact. Connect with us at Universe Media Publishing, and let's turn your vision into reality. Visit universemediapublishing.com today. Your story, our expertise. Together, we'll create magic.
All right, welcome back to the show. From Reuters, builder confidence remains deeply negative. Excuse me, deeply negative as nearly 2/3 offer buyer incentives. Seeing that here in Denver with all the builders. Saying the housing market index increased slightly from 34 in July to 35 in August, but it's remained below 40 for 16 consecutive months, which is, I guess, lower than the average. 30% were cutting prices by an average of approximately 6%. So, and we're seeing that in pre-owned homes too. Days on market, way up, a lot of price drops, a lot of very hopeful sellers. I call it hopeful. I think the market hasn't changed, but it really changed quick. Like you were saying, I think, Nathan, like 6 months, just what happened?
Yeah.
I think one thing that comes to mind for me is I found myself in a really interesting position last year. I was putting an offer on a new construction triplex. It was originally 3 townhomes, but because so many developers had the same idea in Portland at the same time, because we rezoned, they all built these 2-bed, 1.5 or 2.5 bed townhouses. So there's just tons of them, like 400% in 1 year. And so for me, it was like, oh, that's the opportunity. All of these are on sale. I had them combine 3 of them into a triplex. I used a 5% down, owner occupant, loan. And so I think this is a huge opportunity. Actually, I've been selling them to my clients, that a lot of them will cash flow year 1, at least in my market, especially as a furnished rental. And so what I did is I did like 5% down, and then I did a cost segregation on all the units that I wasn't occupying, and I got all of my down payment back. And so it's like a free property, new construction property. And I think that's just like a really easy play for anybody who has rep status and real estate professional status in the United States right now. It's like there are so many developers that are hurting, and it's a really great inventory to buy because your insurance rate's super low, your cost of maintenance is super low. You can cost seg the building now because we have bonus depreciation back. It's a really easy play, especially in expensive markets. It's like even better because you're going to write off even more of the building. So I found it kind of ironic because here I am, I'm like the founder of the Seller Finance Academy, and I'm buying a conventional like new construction property, which is the opposite of my entire portfolio. But I just saw this like window of opportunity. I don't know when we're ever going to have this like type of environment again, where new construction is cheaper than previous construction, and the cost to rebuild is higher than, so it's just an invert right now, which is why builders are really struggling. But what a great opportunity as a real estate investor to cost seg.
Yeah, that's amazing. Well, don't worry, we won't tell anybody, and no one will see this show. So,
but going back, but Mel, looking at it from a different perspective, it underscores the importance of what you teach. Because as a homeowner, you're going to purchase a property, or let's look at it first from the homeowner's perspective. If there's more competition because developers are being more generous in their add-ons, they're lowering their pricing. So as a homeowner, using creative financing, using what you teach is important to keep that open, that open-mindedness. And even as an investor, to understand that there are these pressures in the market, and because there are these pressures in the market, and homeowners are facing this situation where developers are being very competitive with their pricing and with their benefits, that it gives us an opportunity to use a strategy like yours to really, maybe you get I used to always use the analogy of first base, second base, third base, or home run, but maybe you get a property that's a second baser and you convert it to a third base, by learning, the skills that you teach real estate investors.
And then I would add for the home builders that are maybe going to start offering seller finance, realizing that there's people out there that will buy those notes. So they're not going to be stuck with that note for the next 30 years. True. There's a whole community of us that are out there looking for particularly seller finance notes. So there is a back door. There's a back end to that where you're not stuck with hanging on to it, because they do have costs. They have things that they have to cover, and they need to actually cash out of that completely. And I totally understand that. So create that note, especially if you create it in such a way that it makes it attractive for a note buyer. And there's certain things that go along with that. And Mel will talk more about that and how you can kind of help. Man, that's like phase 2 of your teaching program, how to make it attractive to a note buyer, because there's a whole community of us out there, and we'll buy that.
Do you teach that now? You teach that as well? What Nathan is saying in your academy?
Yeah. So I teach people how to do
that.
Yeah, like it's the acquisition side, right? Like we're going out there and we're finding and we're building those notes. But on the flip side, if you want that and for them to have the maximum, value out of that note, then you need to underwrite it. And so I refer my students to a national company called Madison Management Services. They don't pay me, obviously. That's illegal to pay.
Good friends of mine, yeah, I know that
as a lender, but yeah, they're really good, and they're national company. And so not every note needs to be written by an RMLO or residential mortgage loan officer, but owner occupants do. And so yeah, I teach my students that, but I also say, if your seller's not planning to sell it, then put all the goodies in there and just let them know that what you're doing.
Awesome.
Sure.
Cool. Hey, let's go to our next article from Globe Street. Apartment vacancy falls 60 basis points as renters absorb the construction wave. So nearly 190,000 households were formed during the quarter, more than during the previous 2 quarters combined. There we go. Does say residential construction has also been pulling back. Let's see. I don't know where to go with that one. Any comments? Sometimes these don't flow.
Multifamily. I mean, what I've been seeing in my own portfolio is it's really like a consolidation of households. Like it's too expensive to have your own single family house, or it's too expensive to have your own 2 bedroom. So you're moving in with 2 or 3 other roommates. And so I think what we're seeing is folks that used to be able to live outside the apartment world are now consolidating households. And so that vacancy rate is dropping. I would be really interested to see what it looks like on the single family side of renting, if that's suffered because of this move. But that would be my hunch is we're just seeing that drop because people have to consolidate households to survive.
Yeah.
That's an interesting point that I didn't even consider, Mel. Interesting point. And yeah, it makes a lot of sense. I think that's why there's even coaches. Jonathan Stogsdill teaches on how to house hack and how to, co-live and that. And I think, and it didn't even occur to me that, that could be one of the factors of that, that vacancy rate.
All right, should we jump into our fun news item? Let's do it.
Yeah, I get thanks for on
that. This is our last one. United Press International, odd news. An escaped sheep boards bus and gets taken through a car wash. So this was in Germany. Sheep wandered away from its pasture into like a bus depot, basically, and went into an unlocked bus. And then some guy was walking through, checking things out, and oh shoot, there's a sheep on the bus. And I guess they just fired up the bus and took it through the car wash, the big bus car wash. And apparently it was chill. It just hung in there until the owner, they went, I guess it had a tag of some sort. They found out the owner and called him, hey, come get your sheep. That's fun.
I'm wondering if they did an internal clean of that bus as well.
Right.
That's what I was thinking. I was like, I'm going to wash the outside, do the inside.
The inside probably needed more cleaning than the outside, but
Yeah.
I was surprised to hear that there was a bus car wash. Actually,
Yeah.
It makes sense. But I was surprised to hear that. I was not as surprised as this, as the sheep being inside the bus, but I was surprised to hear that as well.
Since we're on the subject, do you guys have any stories related to real estate and having animals? I've got one right off the top of my head I could think of.
Oh yeah, go for it.
I've had raccoons in the attic. That was interesting.
That's a common one, right?
I mean, bless my realtor. This is where it separates realtors versus realtors, where some guys would be like, well, I'll call somebody and we'll check it out. But no, this guy out in Columbus, Ohio, he got up there himself and removed the raccoons. And like, man, good on you. Like, that's a step above, above and beyond, like literally.
I guess the story is I used to buy homes in neighborhoods that were rough neighborhoods. I grew up in New Jersey. And I grew up in northern New Jersey, and I invested in Passaic County and in Essex County. Newark, New Jersey, I'm sure everybody's heard of Newark, New Jersey, or Patterson or Passaic. So I would buy homes sometimes in the hood. And I had a company that I hired to bring attack dogs, and they would drop them off in the evening. Mm-hmm. These houses were boarded up, so they would drop them off in the evening, and then they would come in and get them out in the morning. Unfortunately, 2 fellows broke in to try to steal the, typical thing. They steal the pipes and they steal, whatever's lead in the house. And they were greeted by these 2 German Shepherd attack dogs. I never found out what happened, but the one that I even hired a fella who would come in and he would live in some of these houses along with the attack dogs. And he was a guy that was kind of down and out, but he worked, that's what he did. I would say, look, I'll pay you to come in and move this house. You live for free. I'll give you what you need in order to be able to, stay there. But he told me that he never saw two guys jump so fast and run so fast in his life. But that's the only thing, only experience I've had with animals and investment properties.
Nice. Mel, you got one?
It just kind of makes me think of when I first bought my first duplex. I got a little FHA off-market duplex, and I remember the tenant that I needed to move out in order to occupy it. She was like the cat lady, the neighborhood cat lady. And, it took a while. I helped her find a new place, slowly transitioned her, gave her money, the whole thing. And she got out. And then, of course, the cats didn't, they kept coming and for weeks and weeks. And I love cats, but I don't want that kind of situation. And so I stopped feeding them. And, fast forward 4 years later, I'm selling my first property. And actually, a friend, a fellow realtor, is buying it from me. And they send me the home inspection report. And it's just like a carcass of a cat that is totally mummified underneath. And they're like, we don't really know how to dress this. It's not technically, it's just really gross. Could you just remove it? And I'm like, I know exactly where this came from.
You remind me of when I was a realtor. I had a lady lived with her son. He was probably in his mid 40s or 50s. And now that you mentioned, and you could literally smell the cats from outside. I'm not talking outside next. I'm talking outside from the curb. It was that strong. Because I bought homes now my memory is coming back. And we would have to gut out the houses and literally gut out the entire all the sheetrock because of roaches. So they could be they're tough. It's tough to get rid of them. And many times we'd have to literally just gut out, tear down the sheetrock to the studs, bomb it, fumigate it in order to overcome that. And it's true that as investors, we bump into the cat ladies, we bump into the hoarders. I mean, I have vividly remember some, clients that were hoarders and when you see that on the TV, when you see, those hoarder, there was something on one of the cable channels about hoarders. That's real. It's real. Yeah. I've been in the cases where you're walking in. This lady had a proclivity to collect newspapers, and she lived on the third floor of the 3-family home, and she was the owner. And there was newspapers from the ground to the ceiling in the entire house, and I'm guessing thousands and thousands of newspapers. And you have to walk in there as though it was a labyrinth, So we do run into these cat ladies or these these hoarders, when you're an investor.
Yeah, when you're in this business a while, you have lots of stories.
See a lot, even as a realtor, you see a lot.
Yeah. I've got two real. I'll keep them quick. I promised this gal that I would help move her out. She was a hoarder. Wasn't terrible. When I took this listing, I didn't realize she had cut a hole in the floor of this condo to access the crawl space, and she had filled it. Oh, no. It took us 3 days to pull stuff out.
Oh my goodness. Wow.
That's awful.
But it was the reason I bring it up. She had black plastic on everything. I didn't see one spider or spider web until the last day I saw one tiny little one. It was amazing.
Wow.
You would
So
expect
she was immaculate in that respect.
Yeah, very clean, very clean. Yeah.
Which is not usually the case with hoarders.
Yeah.
It's not usually the case.
Yeah.
But interesting. So that's funny. She was a clean. I don't think I've ever seen a clean hoarder.
Me neither.
That was wild.
Wow.
Yeah, she'd cook us food and stuff. I'm like, I'll eat your food. Like, it's clean. Like, normally you'd be like, I'm not eating food from the hoarder's house, right?
Sure.
Yeah. My other recent one, I helped a gal, saved her from foreclosure. We were 15 minutes from it getting shut off. Long story, but I walked in. I knew that they had 2 dogs. We had them kind of in the back when I walked in, and then they had 8 cats. Some were theirs, some they were, keep it for friends. So the smell of the cats was
Right.
pretty
It's
significant.
It is powerful, that smell.
Yeah. I had a couple, I brought in some investors, and a couple of them just didn't even go in. They're like, nope. But they took me upstairs, and there was a second bedroom. Walked in there, opened the door, walked in, and immediately I was like, oh, what is that smell? I can't even breathe. Like, what? This is probably not good for my health. Turned out they had mice in cages, aquariums, or whatever. I don't know how many, hundreds, multiple. And that being locked up in that room with the door shut to keep the cats out, which didn't always work. Sometimes the cats got in. In fact, at one point they got in while we had it listed, and they're like, yeah, we're missing some mice. Maybe the cats got them, or maybe they're running around. Like, but yeah, that smell was nothing like cats.
Oh, really? Interesting.
It was,
you know something, but those are beautiful homes. As an investor, those are beautiful.
Yeah.
Only an investor could say that.
Yeah.
Yes.
You can smell the money.
Exactly. So when I used to visit when the case of the cat lady, I was a realtor, but these hoarder homes, as you just said, give me some more. Let me see some more mess, because that means that I have a greater opportunity to make some, to make some money on this property.
Yeah. Love it. I'm sure we can keep going with stories. But guys, that's the end of the news portion of the show. Hang in there. I'd like to thank our sponsors, United States Real Estate Investor Advertising and Real Expert Talks, as well as the Universe Media Publishing. And of course, thanks to our guests, Mel Dorman, Patrick Yepes, Nathan Turner. Why don't you guys let people know how they can connect with you if you would like them to? And we'll start again with Mel.
Yeah, you can reach out to me at either meldorman.com or Seller Finance Academy. My book is also Bank on Your Neighbor right here. And it's widely available on Amazon, or you can look it up on Spotify or Apple or any of that. And it's available for free. So if you want to learn how to bank on your neighbor and not banks and institutions, check it out.
Fantastic. I'll get that one.
Yeah, interesting.
Love it. Patrick.
First of all, Mel, I want to get in contact with you, learn a little bit more about you. You can get a hold of me at patrickyepes.me. There you can learn a little bit about my background. As we were briefly mentioning before we started the program, we're offering what's known as geo optimization, generative engine optimization, or AI optimization. That's one of our services that we're offering, among many services that we offer with Dream Big Marketing Services. If you're interested in learning about it, we provide a free audit where we can tell you whether or not the search engines are citing and recommending you first. Secondly, we do a score report for you to find out, how you fare in regards to your competition. We do a gap analysis, and then we do a deep analysis of your business, of your website, to see where the weaknesses or where the improvements are, in case that you're not being cited by the AI engines. So if you're interested in that free audit, feel free to reach out to me at patrickyepes.me. My phone number is there. My email is there. And love to help you out. If you have any questions that are related to marketing or to AI optimization, you can reach out to me. I'm an open book and always willing to share information. There's, no quid pro quo. Always willing to share information and answer questions that fellow investors might have.
Great. I'm so happy to finally get you on here, Patrick, and hope to have you back another time.
Oh, if Mel and Nathan are on, I'll for sure. And even if they're not, I'll be back.
Nice. Cool. Nathan.
Yeah, you bet. So probably the easiest place to go, the most information is going to be earnestinvesting.com. and that's EARNEST. So earnestinvesting.com, where you can learn more about note investing as an investment class, what we do and how we're doing it. We've got an investment fund. There's also a link over there to the Diversified Mortgage Expo, which is our annual conference that we put on, all about note investing, whether you're creating notes, selling notes, buying notes, or you're involved in some aspect of that world. That's where we all gather. That's where we come together. There's no extra coaching program. There's no pitch up there. Everything is just pure education and networking. I'll know here in the next week, we are talking about, and I'll leave it at that for now, but we're talking about putting on just a 1-day mini conference online sometime this fall. So stay tuned for that. We'll get information out about that as well.
Nice.
Very good. Cool. Well, thanks, guys. Again, I'm your host, James Brown. And remember, if you're an investor-focused agent, you can apply to join our network for free. Or if you're an investor looking for an agent that focuses on investors, go to UnitedStatesRealEstateInvestor.com/agents. Let's see. Also, thanks to our founder and producer, Antonio Holman with United States Real Estate Investor. Follow and subscribe to This Month in Real Estate Investing at thismonthinrealestateinvesting.com or your favorite podcast app. We're on all of them. And if you run across any interesting news, events, or have suggestions for expert guests like we had today, feel free to share by emailing Antonio at UnitedStatesRealEstateInvestor.com. And remember, when one door closes, another door opens to financial freedom. See you next month.